Welcome to Charged Alpha. I'm Hudson, joined by Lana. Today's chapter, Alibaba Group, China's e-commerce and cloud giant, which reported record cloud growth but near zero earnings as AI infrastructure investment absorbed all profit.
Alibaba was founded in 1999 by Jack Ma in Hangzhou, China, an online marketplace connecting Chinese manufacturers to global buyers, built during China's earliest internet era.
Alibaba listed on the New York Stock Exchange in 2014, raising $25 billion in the largest IPO in history at that time. The company maintains a primary listing on the Hong Kong Stock Exchange.
Eddie Wu has served as CEO since 2023. A co-founder and former Taobao head, Wu is the first operator-founder to lead Alibaba in a decade, overseeing the company's AI transformation.
Most recently, Alibaba reported $35.3 billion in revenue, up 7%. Cloud grew 38% with AI revenue tripling. Non-GAAP earnings per share of 84 cents missed the $1.22 estimate.
Cloud was the headline. Alibaba Cloud's AI deployments posted the fastest growth in 4 years. The earnings miss reflected a deliberate decision to absorb operating profit into AI capital expenditure.
Alibaba's core moat is buyer-side scale. Taobao and Tmall host roughly 900 million active consumers, a base so large that merchants have no credible alternative for reaching China's digital shoppers.
In cloud, Alibaba holds the largest Asia-Pacific share. Its Qwen open-source AI model is embedded in millions of enterprise workflows, compounding switching costs platform by platform.
The long-run thesis is AI infrastructure compounding. Alibaba is investing aggressively to capture enterprise workloads before AWS and Microsoft scale in Asia-Pacific, accepting margin compression for long-term share.
Against JD and PDD, Alibaba competes on ecosystem depth. Taobao handles discovery, Tmall handles brand commerce, Alipay handles payments, and Cainiao handles logistics, a stack competitors have not replicated.
China's enterprise cloud adoption lags the United States by 5 to 7 years. Alibaba Cloud is positioned to compound into that gap as Chinese companies migrate workloads to AI-enabled platforms.
The near-term challenge is earnings visibility. Compressed margins from AI spending make forward earnings hard to model. Investors must trust a multi-year infrastructure thesis over near-term earnings.
Regulatory risk is structural. Chinese antitrust enforcement reshaped Alibaba in 2021 with a $2.8 billion fine. The relationship between Alibaba and Beijing remains a persistent stock discount.
ADR delisting risk adds a secondary discount. U.S.-China tensions or SEC compliance disputes could force Alibaba shares off American exchanges, creating liquidity risk for U.S. investors.
The AI CapEx cycle is a medium-term margin catalyst in reverse. As infrastructure matures and workload volumes scale, utilization improves, and Alibaba Cloud's revenue-to-spend ratio should swing toward profit.
Alibaba International, covering AliExpress and Lazada, grew revenue double digits, diversifying beyond China's domestic market and its regulatory perimeter.
At $329 billion market cap, with Asia-Pacific's largest cloud franchise and 900 million active consumers, Alibaba trades at a discount to comparable global cloud and commerce multiples.
Alibaba just reported record cloud revenue up 38%, but wiped out nearly all earnings with front-loaded AI infrastructure spending.
Let's get into the cloud and AI split and what the profit sacrifice means for the long-term thesis.
E-commerce, cloud, and China's AI infrastructure wave, Alibaba is making a generational bet on AI dominance at the cost of near-term profit. Now, let's get into the numbers.
In a single quarter, Alibaba committed $9 billion to artificial intelligence infrastructure. That is more than most tech companies spend in an entire year. The result was a 93% collapse in reported non-GAAP earnings per share. The bulls say Alibaba is buying the future at a discount. The bears say it is spending its way into irrelevance. This quarter makes that argument impossible to avoid.
Welcome to Charged Alpha. I'm Lana, here with Hudson. Today we're breaking down Alibaba Group's Q4 fiscal year 2026, the quarter where one of the world's largest companies made a $52 billion bet that it is about to become the AI cloud of Asia.
Quick orientation. Alibaba Group, ticker BABA, is headquartered in Hangzhou, China, founded in 1999 by Jack Ma, with approximately 230,000 employees. Alibaba's fiscal year ends March 31st, so May 2026's report covers January through March 2026, fiscal Q4.
The business has four major segments. China Commerce, which includes Taobao, Tmall, and 1688, the core domestic marketplace engine. Alibaba Cloud, Asia's largest public cloud and the AI growth vehicle. International Commerce, AliExpress, Lazada, and Trendyol serving global markets. And a portfolio of logistics, entertainment, and financial services assets, including a stake in Ant Group.
CEO Eddie Wu took over in September 2023 from Daniel Zhang, as Alibaba executed a major restructuring into 6 independent business units. Wu is a founding-era technologist who has pivoted the company's entire strategic narrative around AI, positioning Alibaba Cloud as the infrastructure that powers the AI economy across Asia and emerging markets.
Q4 FY2026 revenue was $35.3 billion at a 6.90 renminbi to dollar exchange rate, translating from 243.5 billion renminbi. That beat the 34.2 billion consensus estimate and grew 3% year over year, a modest beat on a modest growth rate.
The earnings story is where it gets complicated. Non-GAAP earnings per diluted ADS, the metric Wall Street tracks, came in at 9 cents. The consensus was $1.22. That is a 93% miss, not a miss, a collapse, and it was entirely deliberate. Alibaba spent $9 billion building AI infrastructure in the quarter, collapsing the non-GAAP profit line in exchange for cloud capacity.
GAAP EPS, by contrast, was $1.50, a beat on GAAP consensus. But GAAP includes $3.8 billion in investment gains from Alibaba's portfolio holdings, which are non-operational. The operative profitability measure is non-GAAP, and on non-GAAP, this was a historic miss, driven entirely by AI capital expenditure.
Alibaba Cloud is the number to watch. Cloud revenue grew 18% year over year, and management described triple-digit growth in AI-related products, including API services, model inference, and GPU compute rentals. The cloud business passed a threshold this quarter. AI workloads are now a material driver of the segment's growth trajectory.
Alibaba also bought back $4.1 billion of shares during Q4, reducing its diluted share count by approximately 2%. Since 2022, the company has retired over $35 billion of market cap through buybacks. The capital return program continues even as AI capex accelerates. Alibaba is simultaneously spending aggressively and returning cash.
The headline announcement on the call was the $52 billion AI and cloud capex commitment for fiscal year 2027. That exceeds the prior 3 fiscal years of capex combined. Management framed it as a strategic inflection, the same bet Amazon made on AWS in 2006 and Microsoft made on Azure in 2014. Whether the analogy holds will be answered over the next 3 years.
Eddie Wu joined Alibaba in 1999 as one of the original 18 founders. He served as Chief Technology Officer before becoming CEO, unusual for Alibaba, which has historically been run by business builders rather than technologists. On the Q4 call, Wu was unambiguous. Alibaba is betting that AI demand in Asia will be as large as in the United States, and that Alibaba Cloud's scale and local expertise position it to capture the majority of that market.
Wall Street's consensus on Alibaba is constructive, with 30 buys, 5 holds, and 2 sells. The average price target sits around $155 against a current price near $130. The dispersion reflects a genuine binary. Does the $52 billion AI bet pay off, or does it permanently compress margins while competitors catch up?
The bull argument from major houses like Goldman Sachs and Morgan Stanley centers on cloud re-rating math. Alibaba Cloud grew 18% in Q4. If it sustains 20+% growth for 3 years, the cloud segment alone could be worth $150 to $200 billion on a sum of parts basis, roughly the entire current market cap of the company, meaning you get China Commerce for free.
Bulls also point to valuation. At 8 times enterprise value to EBITDA, Alibaba is priced like a stagnant value stock, not a hyper-investment phase cloud business. On a 2-year forward non-GAAP EPS basis, when the AI capex cycle normalizes, the stock may be trading at 12 to 15 times forward earnings, which is objectively cheap for a business with Alibaba's scale.
The skeptical view focuses on execution risk at extraordinary scale. $52 billion in capex is an enormous commitment for a company operating in a geopolitically contested market with regulatory overhang from both the Chinese government and U.S. sanctions risk. If AI cloud demand in Asia does not inflect as sharply as management expects, the capex cycle could destroy years of earnings with no commensurate revenue benefit.
PDD and Douyin remain the domestic e-commerce concern. Pinduoduo's value commerce model and Douyin's live streaming commerce have taken meaningful consumer attention and GMV share from Taobao and Tmall. If China commerce revenue growth stays at low single digits, while cloud spending absorbs all the free cash flow, the stock's re-rating thesis has no near-term catalyst.
The bull case starts with the cloud inflection. Alibaba Cloud's 18% growth rate in Q4 is already accelerating from low teens earlier in FY2026. If AI, API traffic, model inference, and enterprise AI application workloads continue to scale at triple-digit rates within the cloud segment, total cloud revenue could exit FY2027 growing at 25% or more. That re-rates the cloud segment from a commodity compute multiple to an AI infrastructure multiple.
Alibaba's valuation provides optionality. At 8 times enterprise EBITDA on trough earnings, the stock prices in zero cloud upside and no recovery in domestic commerce. If either normalizes, cloud margins recover as capex plateaus, or China consumer spending rebounds on stimulus, the earnings recovery from 9-cent non-GAAP EPS back toward $5 or more would be one of the more dramatic earnings re-ratings in megacap tech history.
The bear case starts with duration risk on the capex cycle. $52 billion in FY2027 is a commitment, not a ceiling. If cloud revenue growth does not inflect within 12 to 18 months, Alibaba will face a choice between continuing to burn cash on a bet that hasn't paid off yet or cutting capex in a way that concedes the AI cloud market to competitors. Both outcomes are bad for shareholders.
Geopolitical risk is a permanent structural discount on Baba. The U.S. can impose additional sanctions, restrict GPU exports, or revive delisting threats from PCAOB non-compliance. China's regulatory environment has already cost Alibaba $340 billion in market cap since 2020 through the antitrust campaign against Jack Ma's empire. Neither of those risks has been eliminated. They've just been quiet recently.
And competition from Pinduoduo and Douyin is structural, not cyclical. These platforms have built consumer habits around discount commerce and entertainment-driven shopping that are not easily disrupted by incremental improvements to Taobao. If China's e-commerce market is bifurcating into premium and value segments, Alibaba occupies an increasingly uncomfortable middle ground that Temu and Douyin attack from opposite directions.
Options activity on Alibaba was constructive following earnings, with the put-call ratio sitting near 0.85, slightly put-heavy relative to the stock's historical baseline, reflecting the market's ambivalence about the 93% non-GAAP EPS miss. Call buyers targeted the $140 to $155 strike range for the September expiration, betting on cloud revenue acceleration in Q1 FY2027.
Implied volatility was at the 60th percentile, elevated relative to Baba's recent range given the magnitude of the capex announcement and the EPS miss. The options market is pricing in a binary outcome for the next 2 quarters. Either cloud revenue inflects and the stock re-rates toward 160, or capex credibility breaks down and the stock tests 110.
Alibaba repurchased $4.1 billion of shares in Q4, which is as meaningful an insider signal as any. The board is authorizing large buybacks at $130 per share, implying their assessment of intrinsic value is materially above the current price. Jack Ma, while no longer on the board, has not reduced his minority ownership stake. Co-founder executive alignment remains intact despite the succession of leadership from Ma to Zhang to Wu.
The primary catalyst for Alibaba is Alibaba Cloud's revenue trajectory. If Q1 FY2027 cloud revenue growth accelerates above 20%, and management provides clear evidence that AI, API, and inference workloads are filling the new data center capacity, the market will begin pricing cloud on a sum of parts basis rather than a conglomerate discount. That single re-rating could add 30 to 50 billion in market cap.
International commerce profitability is the second catalyst. AliExpress and Trendyol have been loss-making growth investments that consume free cash flow. If either reaches segment-level profitability in FY2027, the elimination of that drag would add directly to the consolidated non-GAAP EPS that has been crushed by AI spending. Bulls have been waiting for international commerce to turn for 3 years. Any sign of it arriving would be read as incremental positive.
The key risks are the inverse of the catalysts. AI CapEx duration risk. If the 52 billion FY 2027 commitment becomes 60 or 70 billion in FY 2028, and cloud revenue has not yet inflected, the market loses confidence in management's capital discipline. Regulatory risk from both Beijing and Washington creates binary event risk that no financial model can adequately price. And China domestic commerce share erosion to PDD and Douyin is a slow-motion risk that may not trigger a sell-off, but quietly prevents re-rating.
That's the Alibaba Q4 FY2026 breakdown. A revenue beat on modest 3% growth, a historic non-GAAP EPS miss driven by $9 billion in quarterly AI spending, and a $52 billion CapEx commitment that is either the smartest investment in tech history or the most expensive error a mega cap has made in a decade. Subscribe to Charged Alpha so you're there when the answer starts to become clear.
Charged Alpha content is for educational and entertainment purposes only. Nothing you hear on this show should be taken as financial advice. We do not hold positions in the securities discussed unless explicitly stated. Always do your own research and consult a qualified financial advisor before making any investment decisions. This is Charged Alpha. We charge forward, so you stay informed.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.